Good afternoon, all, and thank you for joining our panel discussion on supply chain finance and the impact of the last year on the global supply chain. We wanted to change this conversation up a bit from the traditional supply chain finance discussions that we've had before and focus a bit more on the transformations our panelists have witnessed in their supply chains and businesses in the last year, and also discuss a bit on how this has prepared them for what's next. So I'm very excited to be joined with the 5 panelists for today's session. Please welcome Paul Bingham, Director of Transportation and Economic Consulting at IHS Markit; Dominic Capolongo, Executive Vice President and Global Head of Funding at PrimeRevenue, a supply chain fintech platform; Robert Santo, Director of Financial Services at Diageo North America; Alvin Moreno, Director of Global Supply Chain and Credit Risk at Nestle; and last but definitely not least, Michele Pascoe, CFO of Route 21. As the panelists know, this is an open discussion, so I'm going to direct some questions towards individuals, but others should always feel free to jump in and add any views and comments that they have. And in addition, there will be a Q&A session towards the end of the panel for those who would like to submit their questions to the panelists. So I wanted to get started, and I'm going to start with Paul. Paul, given your experience in the transportation industry, would you mind providing us more of an economic view of the changes and impact that you've seen in the last year?
Yeah, thank you very much, Kathryn. I have about 30 years of experience now in supply chain, international trade, and freight transportation consulting, with an emphasis and focus on economics and the conditions around demand and supply in the industry, globally covering all modes of transport, centered now on North America, but over my career, truly working globally. And I work now for IHS Markit, global provider of analytics and information to companies in all sorts of industries, cutting across supply chains and cutting across countries and regions. I'm in the Economics and Country Risk Division, where we supply forecasting and quantification of risk that's used in supply chain management, including financial management. But I've been asked to start with sort of a big picture, very quick summary overview of where we've been in the economy this year and our company's at least short-term look on the outlook. Obviously, this recession that we've all been living through is unlike any other in our careers, our lifetimes. The COVID-19 driven recession started globally in different regions at different times. So it started in China and Asia, first, obviously in the first quarter. And then we saw its greatest impact in the second quarter. And then we've seen recovery start. And in fact, we're in recovery right now from the recession, perhaps the deepest and yet shortest recession the world economy's ever seen, where from a global perspective, we're not back to where we were before the pandemic, by any means. And the recovery, unfortunately, the pace of recovery is now diminishing from what we saw in the third quarter. Our company's forecast for the world economy overall is that for this year, by the time we get to end of December, the world economy will have shrunk 4.5%, that's in GDP terms, before we see a recovery that's fairly strong in terms of pent-up demand in 2021 of 4.4%. If we look just at the United States, the contraction now that we're forecasting measured on an annual basis compared to 2019 is a contraction of 3.5% before a recovery next year of 3.2%. Now, if we break it down, quarter by quarter, we saw in the second quarter this phenomenal drop of 31.4% in one quarter, almost unthinkable. But then we've seen the impacts on the supply chains of the enormous recovery that we saw roaring back in the third quarter with growth of 33.2%. Now, those are on a quarterly basis. If you analyze those, they're less than double digit, but they're still, record declines that crushed the supply chains as things shut down in the second quarter and then came back so strongly in the third quarter. We see a much weaker pace even in this fourth quarter, and then going forwards with the end to the fiscal stimulus that we saw at the pace of 2.9 trillion in the second quarter from the U.S. government, and now half of that in the third quarter, without additional congressional action, much less lingering into this quarter and much less even into 2021. That affects consumer purchasing capabilities and their ability to consume even more. And so the inventory rebuilding and the sharp spike, especially in e-commerce, of consumption of goods and the trade of those goods that we saw in the third quarter, we don't expect to continue at the same pace. However, we don't expect a W-shaped dip back into recession. We're not anticipating a decline in trade from this point going forwards. And in fact, for the year, we're forecasting that imports will be down in total. Now, this isn't containerized trade. This is total value of U.S. import down to double digits, about 10%. But we expect a recovery in 2021 of 11%. So we have enormous demands coming at the supply chains in 2021 as the volumes for the year come back. And I think I'll leave it there in terms of interest of time. Be happy to incorporate discussions of the macroeconomic and industry-specific conditions affecting trade as we get into the Q&A.
Perfect. Thank you very much, Paul, for that. I did want to actually now direct the next question to Dominic, as Paul gave a very global view in terms of the macro view of the economy. I wanted to ask Dominic something somewhat similar pertaining towards the actual suppliers in the supply chain, and what PrimeRevenue witnessed with their clients, as well as those suppliers and the reaction and the trends that happened in 2020.
Sure. Thanks, Kathryn. One of the things that our platform has been around since 2003. Over the course of the years since inception, we've done over 3 trillion transactions over the platform. Last year alone, it was well over 250 billion. So it gives us the opportunity to actually analyze trends in a more historical context with all the data that we have. One of the things that we saw mirrored what we saw back in 2008. Economic distress led to a reduction in the liquidity available to a lot of suppliers from their own proprietary sources. So banks and other funding sources retrenched or pulled back from the market, took a much more conservative view of credit, and looked for ways to restrict credit availability to many businesses, especially those that are small and medium-sized enterprises. So a lot of suppliers found that their access to credit shrunk, and the only available credit that they could find was through the supply chain programs they participated in. So again, mirroring what we saw in 2008, there was a significant increase, especially in more distressed industries, from the suppliers in terms of the use of the supply chain programs and the percentage of invoices that they traded. We saw a material spike in the number of invoices that suppliers were trading as they sought liquidity to shore up their business or to meet expenses and to keep the business afloat. In certain industries where there was a particular pullback, like auto and retail, suppliers literally had to think longer term, because the auto industry and the retail industry obviously had a significant drop in sales, and as a result, they were buying fewer goods. So the suppliers didn't see new orders coming in, and they didn't know how long that was going to be in place. So they had to think more longer term, which meant that in those industries and those like those industries, we saw an even larger increase in the trading percentage. Let me compare that for a moment, and this is something we didn't see in 2008. Certain industries, because of the nature of this crisis, actually saw a material increase in their business. So much so that it put material stress and pressure on their supply chains. And the supply chain program was really more of a way to enable their suppliers to continue to produce the goods necessary for them and actually increase the amount that they could sell them. So those industries are food and beverage. A couple of those industries are food and beverage and food retail. So large grocery store chains saw a material increase in business. Anything consumer goods related saw a material increase in business, and their supply chains suddenly were under massive pressure. And so again, while we saw an increase in trading for the suppliers or use of the programs, it wasn't as marked as we saw in automotive and retail. But what the buyers did is they stepped in to provide, make sure that the supply chain was available to the suppliers so that they could continue to obtain the raw materials necessary to provide to continue to supply the goods through the supply chain. So very interesting dichotomy in impact. The bottom line is that we faced three specific crises in this. One was a liquidity crisis where the banking system was under material stress because people drew down on lines in greater number than they ever have historically, which made all the liquidity models kind of fall to the side. Suppliers were desperate to make sure they had liquidity to sustain themselves through the crisis, and buyers, frankly, were looking to ensure that their suppliers stayed in business so they didn't have to rebuild their supply chain when the crisis ended. So supply chain the programs actually worked quite well, but for many different reasons.
Thank you for that. And that's very similar to what we saw at Bank of America as well with our clients and the supply chains. Going into some deeper detail, going into actually what our clients have experienced, I did want to steer the discussion towards the businesses that the panelists are actually part of. So Robert, Alvin, and Michele, I wanted to, I think it'd be beneficial to hear some of the transformations your businesses needed to do and navigate through this year. How did you continue to get product out to the market? How did your supply chains change? Your business sectors change? I'll start with Robert on the Diageo business and what focuses you guys needed to make changes to. But again, everyone is open to making comments and points. So Robert, I'll ask you, how did it go with Diageo?
Excellent. Thank you, Kathryn. And for those that don't know, Diageo is in the adult beverage industry. We are the leader when it comes to spirits, and we also have beer on the Guinness side. So as Dominic was referencing, we've experienced a lot of challenge from the supply side as we saw a significant shift, which was a mystery as to how this was going to shake out in the second quarter of this calendar year. A quick update on the spirits industry. So as of last week, the 4-week trend for spirits is up 23% and 52-week up 14%. So the shift in our industry went from on-premise or restaurants and bars to off-premise, being a liquor store, supermarket where you bring the product home. So we really didn't know what was going to happen there, and our supply chain got stretched by the consumer choosing certain brands that they would walk into a liquor store or supermarket and not spend a significant amount of time shopping, as we all know why, and pick brands that they are familiar with and pick sizes that will last longer. So we had to shift our model on the supply chain side when it comes to raw materials and how we produced significantly different from what we were forecasting and what we thought was going to happen. Two other quick references is tin in our industry and cans. Very difficult to get tin for our production of seltzer cans, beer cans, and then another spike in tequila, which wasn't forecasted, significant spike. So right now there's some challenges there about meeting demand. I'll pause there, Kathryn, for Alvin or Michele to jump in.
All right, this is Alvin. So following the same comments, Dominic and Robert. And Robert, I'm doing my fair share to get spirits into our fridges, but yeah, we've seen a shift from hospitality where that business has eroded, basically pretty much stagnant, very little movement there, and a huge pressure on the retail side, the CPG side, to a point where you see supply chains and capacity struggles, and the inability to keep up with demand. So think about, in the past it was all about lean. It was all about having a lean supply chain. Very little waste in there, but what that does, it puts pressure on the ability uh, to adapt to demand, huge increases in demand. And that's what we're seeing right now. So we're seeing demand on the CPG side growing significantly and struggling to keep up with that demand, either because raw materials are not readily available or because manufacturing constraints. So that's where we're seeing that shift.
Michelle, I'll ask
Okay,
you the
well,
same, given the retail industry was one of the hardest hit industries. How did you continue to keep going?
yeah, to add on to what Dominic mentioned earlier about retail being hit the hardest, we saw the business transform in a matter of 45 days. From in early February, we were struggling to get our production out of China because China obviously started shutting down much earlier, to, oh no, we're shutting the entire chain down. So we shut down 650 stores in a matter of 48 hours. And not knowing when we would reopen, we proceeded to cancel millions of dollars of orders with our vendors, who, as Dominic mentioned, were already facing liquidity constraints from their credit facilities, that now across the entire retail sector, everybody was canceling millions and millions of dollars of orders. So it was a double whammy to the vendors and to what would be the unknowns on how would they produce when we opened back up. So when we did open up, we lost several vendors who just went out of business due to the shutdown impact. And I failed to mention earlier, we're a fast fashion retailer. That means we go to market and buy design and product directly from vendors. We don't source anything ourselves. So we are 100% reliant on our vendor base to deliver the goods, and 90% of the product comes from China. So when we did open back up, we were very successful and had highly profitable comp store sales performance, which we had not planned for that demand. So we were scurrying to get product and working hand in hand with our vendors. The supply chain finance line that we have in place with B of A was a lifesaver for many of our vendors who are on the small side and extremely undercapitalized. And I believe that if we had not had that facility in place, we would not have been able to get the flow of goods that enabled us to support consumer demand over these last few months. It's stabilized somewhat, but we're being very cautious with our production orders because we are uncertain about what's going to happen with holiday and into the fiscal 21 retail demand. So it's been an exciting CFO ride, and I do think this is nothing like what we saw in the 2008 crash. And we are crossing our fingers that we get some stimulus money back into the consumer's hands, because I think without it, it may be a somewhat sad holiday season.
Mm. So with a lot of, thank you very much for that, with all the points that the three of you have brought up, you know, what have you, I don't want to say what you've learned from it, but how are you taking this forward? I mean, what risks have you started to mitigate against? You know, how do you look at your supply base? Are you thinking of moving manufacturing, moving where you're sourcing from, or are we still sort of feeling out, you know, the rest of this year and seeing where 2021? I'm interested to just hear where you guys are going in each one of your businesses, given, you know, Robert, changing of business sectors. You know, are the restaurants? Are you focused on the restaurants going forward, or is it really on the grocery?
Yeah, so I'll start off and then hand it off around the horn. It's interesting, especially right now, as Michele mentioned, the holiday season is coming. And it's extremely important for our business, as many, with the customer orders coming in much quicker than they have before. And in the United States, for example, there's a 3-tiered system in our industry. So for the most part, we sell to distributors who then sell to retail, or we sell direct to the state liquor control boards, as many of you might be familiar with. So the orders are coming in much sooner than they ever had before, which again puts a lot of stress on you know, the forecast. Not that the forecasts go out the window, but as Alvin was talking about before, trying to have a lean supply chain just was not possible. We realized that earlier as we're coming into the holiday season. So we did anticipate that, and we did go with the short-term trends that we learned from, you know, June over July and August as to where we need to focus a little bit, while also taking into consideration, as you mentioned, Kathryn, many states are opening and closing. So the restaurants and bars here in Connecticut, where I am, have just gone to phase 3, where went from 50% to 75% capacity. So the sizes that you would see behind a bar, this 750 milliliter bottle, we weren't focused on before, but now we need to in certain states. So it's really challenging. And Michele went down this road also, where we need to have more inventory than we would have had prior coming in to cover all of those different obstacles that we're dealing with. And I'll hand it over to Alvin.
So, Robert, let me ask you a question, and I'll ask this to Alvin and to Michele as well. As we start to come out, and it sounds like you're doing this, we're seeing buyers start to, because there's a big uncertainty as when we're going to emerge from this and how we're going to emerge. And with the stresses in the supply chain that people saw during the crisis, what I'm hearing from, and you mentioned tin, we have a can manufacturer as one of our clients. They have the same issue with tin. So what they're talking about doing now is stocking up on tin, like getting as much as they can in advance, which puts weight on their own balance sheet. Right now, they've got a bunch of tin just sitting in a warehouse somewhere, which is not exactly good for any financial metric to have a lot of materials. Are you guys seeing the same thing in your industries? Are you doing that, where you're trying to, you know, because of the uncertainty of how we're going to emerge, you're starting to, and the risk in the supply chain that has really come out through this crisis, buying ahead?
Building up inventory.
Right, Dominic. I mean, you got a hedge on obviously commodities, but there's added costs. There's the cost of adding a lot of fat to the balance sheet, obviously, higher inventory and everything else, but there's also a lot of other costs associated with PPE and everything else that is putting stress on margins. It's putting stress on margins on the whole supply chain. And when you're operating with very thin margins and now you're adding additional cost, that's a separate stress, and it's a long-term stress. How long is it going to last? That's the uncertainty right now. But yes, I mean, we're seeing more robust supply chains now, where they were more lean oriented before, because now it's the new world. We don't know what that's going to look like going into 2021 and how long it's going to last. But at least right now, it's focused on the ability to meet that demand that's out there and take advantage of it. Because if if you don't, then you're missing out on opportunities. And then come 2021, 2022, it might change entirely, but we'll worry about that when we get there. Right now, we're dealing with the present and we're assuming about the future. Yeah, but to your point, yes. From a financial perspective and from a risk perspective on our suppliers, we have to model them. What do they look like now? How leveraged are they? What is this additional debt or less liquidity or pressure on liquidity and less sales and impact on the margins going to look like? I mean,
Michelle,
yeah, it's
it sounds like, I mean, Michelle, your supply chain, you probably have even the same pressures that Alvin's just describing in terms of trying to figure out the strength and trying to provide as much support as possible while thinking ahead in terms of what you're going to need to fill the stores.
Yeah, exactly. And unfortunately, apparel isn't like wine. It doesn't store.
yeah.
It doesn't get better with time. So what we've done is we've put flexibility in our delivery dates. So we have added probably a 2-week window on average to our in DC delivery dates, which gives us flexibility to pull forward product as we see demand. And we will warehouse core product that is replenishable. That's about 30% of the inventory in our stores, so that we can feed the stores as the demand indicates, without generating excess inventory, or bigger yet, obsolete inventory, especially seasonal inventory that will be worth $1 a unit come post Christmas. So that's how we're managing it at the moment.
Right.
One corollary question, Michelle. Since you're sitting with all this inventory in the warehouses to bleed it out as you need to,
Mm-hmm.
and manage your balance sheet, we've seen a particular pickup in inventory finance solutions like consignment, where somebody basically takes the inventory and holds it for you. Are you seeing an increase in use of that as much as you're trying to feed your supply chain and keep it healthy while you wait for everything to go back?
Yeah, I mean, it's interesting that the consignment model is finally hitting apparel. That's always been, from a retail perspective, an option, particularly in the grocery industry, but it is seeping into apparel now. We have not adopted that because, fortunately, we went into the pandemic with a very strong liquidity position. But it remains an option for us should we need it.
One thing that is critical is understanding your supply chain, basically all your supplier base. So many of you have mentioned the financial crisis that took place in 2008, 2009. So we learned lessons from them. And one of the lessons was understand your key players. I mean, if you look at worldwide, Nestle has over 500 million suppliers, not all active at any given place, but rather than focus on all of them, you focus on the critical ones, the ones that represent the majority of the business and the ones that are critical in a sense that they can stop supply chain. So we've done a really good job identifying those suppliers so that if we had a financial crisis, or in this case, a COVID crisis, at least we know where to focus. And there'll be some exceptions, obviously, but at least we know where the focus is on your packaging, your manufacturing, your key ingredients, and your last mile. So we know where we need to focus our efforts and keep our eyes out and identify those potential risks that are lurking out there. So that's critical, understanding the makeup of your supply chain and where those risks are, and model out. Okay, so you have a transportation supplier, and 40% is in the service sector. Well, whether it's cruise ships or restaurants, then they're suffering there, and the remainder is on CPG. Well, you can start modeling. Well, if they lost this amount of volume, what is their balance sheet going to look like? What is their P&L going to look like? Okay, take out that volume and model it out, and then you have a better idea of where those risk factors are, and which vendors you need to work with. You mentioned B of A. Yes, we have the reverse factoring program. Maybe that's an option, but at least the first step is identify where those risks are, and identify where you don't need to worry, because you don't have all the resources to look at everything. So.
Yeah, I think it's a great point, taking more of a financial review of your main suppliers that run the business. I'm not sure that necessarily every, procurement area had taken that sort of view of it, but really taking a financial view of each of one of your key suppliers is something. When you had said that before to me, I thought it was a really great point that I don't think necessarily every company really takes that view.
Yeah, I think it's worth highlighting that. And here at Diageo and many other companies, there's always been a significant focus on customer financials, analyzing our customers, and maybe not as much on the vendor side, which has transitioned, which is so important. And I think, Kathryn, to your question earlier, I see that as being something that carries on after we get through this, is a shift in total front and back end, analyzing the financials, which wasn't always the focus before.
Yeah, I mean, that point on having a lean supply chain and utilizing that supply chain is an important point, but having that financial view and knowing if you have to look to to broaden it and diversify your supply chain, I think now is a point that I think is coming across in everybody. What they're saying is that, the idea was utilize what you had, which is what you want, but at the same time, you also have to be able to diversify if you can't get that product at that point. If you do have suppliers that are hurting or need financing elsewhere, or are just not going to survive. I think that's something that just has to be apparent at this point.
Yeah, and the reason I brought up understanding your suppliers, and I mean, you're looking at obviously not just their financial composition, but sustainability, quality, safety, sourcing, but also keep in mind that in most cases, you have an issue with a supplier, you can't just replace them overnight. You have to go through the process of approving them. You have to do the background, compliance, safety, sanctions, and everything else. It takes weeks, if not months. So you could have a disruption, and that's why it's critical to understand, hey, your critical ones, either because of volume or sources, single source, or proprietary formulas or proprietary processes. So yes, it is critical to look at those, and those again are lessons that we learned from 2008, 2009 that we carried forward. And just a point that I want to make on why it's so important to look at the financial condition of your vendors. If you look at almost any public company, they disclose risk factors. And you're always going to find risk factors about liquidity, but you're also going to find risk factors about supply chain disruption. Yes, we've taken measures to identify it and build mitigating strategies. Well, that means you're looking at also the potential of a key vendor going bankrupt and causing a disruption of your business. So.
That's a great point. One of the things was a big topic that we keep talking about in banking, I guess, as well as our clients is, are individuals moving their supply chains? Are you looking to move vendors from APAC to different regions, or bringing it back to the US or Latin America? So I guess I'll just have that open-ended question, but also Dominic as well, with the clients that you see, are the sourcing changing? Are manufacturing, practices changing? So just interested to hear from everybody. I don't even, Michele, if you had a point, because I know that you're the business is very APAC related. I didn't know, even in APAC, is it moving out of China to Vietnam? Is there different sourcing going on?
Yeah, we absolutely are in constant conversation with the merchants and in turn with their vendor partners. We have to have alternatives to China. The challenge is that the balance of apparel production in Asia is very underdeveloped. If you think about how many years have been spent building up the apparel and footwear industry in China, to move it, Vietnam is a great option, but they don't have the capacity developed at this point. But absolutely, we are maniacs on a mission to work with the vendors to find alternative sources, because there's also the question of consumer preference going forward, and how will they react to product sourced in China, and then also the other issues in China. Right now, there is potentially it could be a cotton shortage, because much of the cotton is now potentially being produced in prison camps or with child labor. So we're keeping our eye very closely on that. So absolutely, we need diversity in the supply chain, and it is a top priority.
And I would say the same as Michele said, not to go on and just repeat, but we're also looking to, while doing everything Alvin said and Michele said, we're also looking to help any way we can the small, maybe diverse vendor or supplier, and see how we could work with partners like Bank of America and some others to ensure that we're putting our best foot forward while doing exactly what Michele and Alvin said, consistently looking at our portfolio of suppliers and identifying those that are critical to make sure that we mitigate that risk. So wanted to just touch a little bit on making sure that there is some attention to that small vendor that might need a little help, I guess, or attention or focus also.
I was going to ask Dominic if he's seeing more of an increase on those small businesses as well. Is that where the utilization is coming from in some of the programs? Or
So a couple of things. So you asked about whether we're seeing any switches. So the short answer is utilization is across the board. We're seeing utilization come from suppliers big and small. We are not currently seeing any material adjustments to the supplier base. But we do know a number of our clients, to the point Michele made and to the point that Alvin made earlier. We do know a lot of people are looking to diversify their supply chains, particularly at the lower levels, right? The smaller folks, and they're doing it in a very targeted approach. They're trying to determine if the supplier is important to the business and kind of adding a second as a backup or things like that. But to Alvin's point, we're not seeing it come through the system yet because it takes a while. By the time the company gets the contract set up, the procurement people engage with the supplier and do all their work and get everything approved and set up the open account with them and the whole bit, we will see the effect of that probably more so in 2021, when we'll see a cycling of some of the suppliers out and these new suppliers come in. But as of right now,
I would just add to that, it probably takes us 6 months at least of lead time to bring on a new vendor, just because of fit and requirements on content, etc. So it's not just, you can't just flip a switch and find a new t-shirt guy tomorrow. So
that's what we've heard from folks. And so as a result, their immediate efforts were put into trying to strengthen and sustain their existing suppliers. So what we have seen in the small suppliers that's taking effect right now was an expansion of the supply chain programs to add those smaller suppliers on and giving them access in the hopes that they can forestall any kind of bad effect by giving them access. And it has nothing to do with, it's just kind of like, we're not going to negotiate anything. Here you go. Here's access. We'll let you use our program as your lifeline. in the hopes that that gets you through the crisis and we don't have to worry about replacing you and looking for a new supplier. Like Michelle said, it'll take months.
Hey, Kathryn, I want to add to that. I think, all the comments here are right about the source supply shifting is coming, but it's more strategic than tactical. As everybody said, it can't be done overnight. And we're seeing it reflected in the trade statistics where we're, importing an enormous amount from China into the United States, despite the tariffs and consumer behavior towards products sourced there. It takes a while to develop your whole supply chain. Obviously, the more complex the products and the supply chains, the longer that takes. Say of the auto industry or something where you've got to go through many more tier suppliers and think about their financial conditions and vetting them. And so what we anticipate is it's going to be more visible in the medium to longer term. We can't anticipate the source supply shifts, actually hit the trade lanes overnight. It's going to take a while, but it's coming, and it will happen eventually with the diversification of supply to lower that source supply risk.
Yeah, I do agree. I mean, I think the initial view was around tariffs, right? That was the initial view where companies were looking to change their supply chains. And then when COVID hit, I think the shock hits it just like Michelle said, in 48 hours, right? You have to close all of this, you have to do all these things where now it's just like, okay, let's just kind of get through this a bit, and then we'll start going back to where we were when we were talking about tariffs beforehand. So yeah, I think we're kind of getting back to that point. So there were some questions that we did get, but I don't know, Alvin, did you want to have any finishing thoughts on that topic that we were just speaking to, or I'll get to the question?
No, I mean, the only thing is about adding a new vendor. Yes, it takes a while because you do have to do the background check on it. You want to make sure that they're you do the sanction check, the quality check, sustainability, making sure that they're not using child labor, deforesting, all the normal, and it takes a while. So that adds to the onboarding of the vendor, and then you have to go through the offering, so yes, it's not overnight, and it takes a while, and you have to find the potential vendors that fit your criteria. So yes, we have a vested interest in strengthening the suppliers that we do have on board, and that's where B of A helps a lot, because it helps them with the liquidity, and it helps our working capital position as well. So yes.
Yeah, I mean, we did see an enormous amount of an increase in utilizations of our programs that we never saw before. In consumer and retail, it was very common just to have the same utilizations peaks every year around October, November, where it's holiday season. And, we saw that a huge increase much earlier in the year of programs where it was just suppliers who had never needed the program or actually weren't using it on a regular basis were just going and getting that access to liquidity when they could. So I'll start with the first question. With the ongoing pandemic, what is the plan of action do you recommend to SMEs facing a liquidity crunch who are trying to access capital in a cost-efficient way? Also, as a supply chain professional, what options do we have to support our suppliers, specifically the weaker links of our supply chain? So I guess that's more for Dominic and myself in terms of how we can support suppliers in the SME space with the liquidity crunch. But at the same time, I open it up to everybody. I mean, the topic of this panel is supply chain finance, and for those who are somewhat new to what supply chain finance is, I mean, this is a way that our clients are able to provide their suppliers that are in a liquidity crunch the ability to get liquidity at a much lower cost than if they were having to go and borrow against their own lines. So a lot of the things that Michelle was speaking to in terms of keeping those vendors whole and in business where they couldn't access that liquidity, their vendors turned to supply chain finance programs that Room 21 had in place. Now, I will say other ways that we see some of these vendors in liquidity crunches that don't have access to supply chain programs from their buyers is we do see that they will go and factor receivables either through a factoring company or through a financial institution. They'll look to sell those receivables of their buyers. So we saw a very big increase in those requests as well from clients of ours who are suppliers looking to sell, you know, receivables of their buyers who are also clients of ours. So that was really what we saw very much in the, you know, beginning of 2020 and up to now. But I will say that the increase in supply chain programs at Bank of America, you know, Dominic at PrimeRevenue, the increase in their programs has been a request, basically, from my standpoint, from suppliers asking their buyers, look, we need you to put this in place so we have this access to liquidity.
Yeah, I would completely agree. I mean, just the topic of how do we increase the, and Kathryn and I, you know, have talked about this, you know, a number of occasions. It's a topic of how does the market opportunity or the market availability of financing increase for SMEs is a topic that's being addressed globally by not only the industry participants like ourselves and our industry association. It's a hot topic for a lot of governmental agencies. So I'm a member of the Department of Commerce's Trade Finance Advisory Council. The main topic we've addressed in this session of the council, this last 2-year session, has been how do we increase access to financing for SMEs. I wish I could say that it's really easy. You just kind of flip a switch. The challenge is multifaceted. It has to do a lot with just continued automation in the marketplace to make it easier for SMEs to really have access. It can be very daunting to go through some of the procedures for some of the smaller, particularly smaller suppliers. The other thing is just lack of education is a big thing. A lot of SMEs are not really familiar with the value and the opportunity afforded by supply chain finance for them and for their business. And so it's just about increasing the education. So it's a very complicated topic, although I think every one of us, and we've talked about it with B of A a number of times, are looking for ways to increase the access for smaller businesses and make it more efficient for them, and always thinking about new structures and transaction frameworks to do that. I know that I will say, and I don't mean to speak for the other folks here, but you know, every one of our clients is keen on increasing the availability, and it is a key aspect of how they look at the supply chain program, that it's universally available. But again, there are circumstances outside of a lot of people's control that prevent it to be just that easy to orchestrate.
Yeah, to your point, I mean, it could seem complicated, but understanding those tools and those options just pretty much adds it adds to the opportunities in your supply chain to work with smaller vendors, to work with a more diverse group of vendors. Let's put it that way. Understanding those tools. I mean, there's situations where maybe smaller cash-strapped companies can't really do business the way you need them to do, but through these programs, it provides them the ability to engage and still deal with longer terms.
True. So, okay, so Robert, there is a question specifically for you. You mentioned a new wave of customers seeking familiar brands for consumption. Has this altered Diageo's strategy for packaging of certain spirits for off-premise consumption?
Absolutely. And it comes down to the sizes where we needed to go to the larger size. We weren't prepared to do that in March, April, and realized we had to be flexible. And that's something we've learned and need to continue to do, is to identify where we need to flex. And that was a significant impact on many of our manufacturing locations. Many different brands, so we're in every category. And I mentioned earlier how tequila was hot. Bailey's, the cordials category is hot right now also, and American whiskeys. So while those, we saw an uptick, there were, the whole industry is growing volume-wise, and certain categories is where we had to pay attention. So it wasn't a blanket shift from what I was calling the on-premise to the off-premise in the strategy, but it was by category. The prepared cocktails also uplift there. So the answer is yes, we have to react, and we're continuing to react, but it's also by category, which is very interesting. I'll pause there.
Thank you. I have one more question. It says, can you share your perspective on the use of virtual card numbers in the supply chain? Do you find it efficient or cost prohibitive?
You want to take a first crack at that one?
Well, I guess I'm not virtual card numbers in the supply chain. I mean, virtual card programs, Dominic?
That's what I'm thinking. That's what I'm thinking the question means, the use of virtual cards or P cards and
Okay.
as an option.
I'm going to open that up to everybody since I am not the virtual card.
Yeah, I could jump in and give some insight here. So a lot of my focus and Diageo's focus, simpler, faster, better. And very often when you can go and use a card, and there's some very, very large, even media and some other suppliers that I was surprised would actually accept and prefer taking a corporate card, whether we call it a virtual card, a ghost card, a peak card, all those, it's a credit card, right? And the good thing for Diageo is, depending on the terms that you're paying that credit card for, there's rebate involved. And just, as I said before, simpler, faster, better sometimes. So we did see an uptick in the possibilities, at least to have the conversation about going with the corporate card, whatever category we're going to call it. I'll pause there for the others.
That's a very good point. I guess, I mean, something that Alvin brought up is that there's programs out there for all sorts of suppliers. And you may not think, like you said, Robert, media, that they wouldn't even be interested in something like that. But I think just being in this industry for as long as I have, I've seen such changes in the supplier behavior and what they are interested in taking and what they would be willing to go on a program for. So I think there are a number of different things that are out there, like virtual card. There's the topic of dynamic discounting is always out there, and the type of suppliers that go from that. I always say I don't think that there's a one size fit all for your entire supply base. I think it's very much, you look at, you know, your entire supply base and what programs are there that would fit perfectly within those different suppliers. So
yeah, no, I think you're absolutely right, Kathryn. There is no one structure that fits every party. I mean, to the point that you made, Robert, I mean, simple is better. The thing that works for virtual cards or the like is they are understandable. So for small and medium-sized enterprises, they understand, because they use credit cards in many cases to finance their business. So they understand the nature of a credit card. It's not complicated. It's simple. It's easily understood. It's not something they have to learn about. So from that standpoint of before, when I was talking about education with SMEs, this doesn't require a lot of education. Now, if they want to educate themselves, they can probably get a cheaper source, but at the end of the day, it still works for them. And so, to your point, Kathryn, I think you just have to have a range of options as you think about the supply chain, from your largest suppliers down to your smallest, and as you expand it and continue to go deeper into the supply chain as these finance programs kind of grow.
yeah, I think I used to find, oh, I'm sorry, Robert, you go, please.
One quick comment. As I heard Dominic speak, it reminded me how important it is to make sure that the majority of the people that touch a supplier or a vendor are aware that those options are even out there. Too often, it's in our toolbox, right, or a tool bag, that there's supplier financing, dynamic discounting, there's virtual cards, and maybe a host of other things. But to make sure we're all aware of that, and the full range of vendors has an opportunity to pick something. Sometimes we forget about that.
Yeah, I think sometimes the view could be that they're competing, that all of these different programs and opportunities or structures are competing against each other. And if anything, they're actually an add-on to what you may already have on a supply chain program. So you are completely correct that it's making sure that you're aware of all of the different opportunities that you can put towards your suppliers. Whether that, be virtual card, dynamic discounting, ESG, all of the things that are out there, especially now, that are available for your suppliers. So I don't know, Michelle or Alvin, if you had any views on other programs that you put into place with your suppliers. And I know, Alvin, you had mentioned that, just there's so many things out there that you can offer suppliers to make sure that they're kept strong and whole.
Right, and understand all your tools so you can reinforce your toolbox and have multiple choices that you can go to. I mean, yes, there's a P card for the smaller ones, or you basically just regular invoice or electronic. But yeah, the more understanding you have, the better you can execute.
Right. And Paul had brought up something in the beginning about access to the information that's out there, and that's something that he works with his clients on in terms of what market information that is available. And I think it's just important that we're all aware of all of the things that we can look into. I don't know, Paul, if you had any last closing pieces.
Yeah, there's some options that are available if different size organizations can benefit from trying to quantify. I don't know, is there a clarification on the question? I'm not.
Oh, no, it was just really you had mentioned a lot of the different type of market information that is out there for clients to actually access.
Yeah, I think,
we were talking about the program.
Yeah, I think the context that we provide is sort of the bigger picture, but yet, can be very relevant and down to very specific levels. So within the individual countries, quantification by sector of different types of risk. And then more importantly, perhaps monitoring it on an ongoing basis to try to pick up changes in risk that can affect the position of participants in certain sectors, so that there's a way to quantify change that's occurring in the conditions affecting the suppliers or your customers in various markets, and to compare them over time, so that from say a diversification of supply chain management perspective, that you can take advantage and tactically use that information to make changes, whether that's a change in policy or an approach with particular supply chain partners, or whether it's decisions to shift for alternatives. Maybe that becomes a more medium-term decision, not a tactical one, but yet you're keeping that in mind so that you don't get caught blindsided like has happened to so many organizations this year.
Thank you. So there was one last question, and I kind of want to get into it with 1 minute left. Do you see, the business-to-business shifting to blockchain for inventory management? Or any of your companies looking into blockchain at all? Might be a simple yes, no, but.
I will say that a lot of people are looking at blockchain. Kathy, Jeff and I spoke about this at the BAF conference. Blockchain has gotten, we're seeing it from banks, from buyer clients, especially larger ones, all thinking about blockchain, how it can simplify the supply chain process, particularly in anything that's documentary focused or document heavy. Inventory tends to be that still. But I think it's 3 to 5 years off before it's of any level that is going to be used globally and is viable from a commercial standpoint. It's more investigation and testing is what I see. I don't know, Paul, you may have.
Same thing with from the bank perspective. I just didn't know if from the business perspective, if Diageo or Nestle or Route 21 had been looking into the blockchain piece for inventory management.
I think we see some of it on the service provider side, on the transportation carriers. Earlier today during the summit, there was one of the speakers from IBM who participates in trade lens. So there are some real applications that are not just in their infantile stage anymore. You know, they're actually in an implementation phase. You know, but as far as, you know, how pervasive that is in the overall supply chain industry, you know, yeah, I agree with Dominic. You know, we're a couple years away, but, you know, the disruption is coming and the adoption is going to grow. And I think it'll be probably not as quick as some people were anticipating 2 years ago, but, you know, 5 years from now, we'll probably be surprised about how far it has actually come.
So for Diageo, there is awareness and discussion, but early stages.
Mhm. Well, I think we are at our time. I just want to thank all of you for joining this panel and having such a great discussion, and I really appreciate it. I honestly really enjoy talking with all of you and hearing all about the different things that you went through, and honestly, I won't say success that we've all had through this year, but you know, you got to pat yourselves on the back that, you know, we've gotten through most of this and coming out of it, and we've learned a lot from it, and I think it's going to help us going into 2021. So thank you very much, all. Dennis, I will hand it over to you.
Thank you, everybody.
Thank you, everybody.